What's up, guys? I'm Eden. I am the Justified Investor. Welcome to the first video on the channel. So, a little bit about me. I'm just a college guy. I've learned a bunch about fundamental analysis on companies. Um, and we're going to go ahead and dive into Celsius, the stock here. What's the growth rate of the company? What's the value of it on a PE PEG ratio? And I'm going to give you my opinion on whether or not I think it's justified to be where it's at. So, of course, do your own due diligence. I'm no way certified as anything, so invest at your own risk. Let's go ahead and get into this. So, just starting out with the stock price here. Over the past year, I guess it's a little less than a year, September of 2025, this stock has been completely destroyed. Wall Street doesn't want this stock. A lot of people are just selling it off. And this is really not just a Celsius thing. Many consumer discretionary stocks have been just hated recently. Not many people want them, so they've been selling them off. So we're going to look at the numbers here and figure out if I think this is justified. So, what's the growth rate here? So, this is off of Yahoo Finance here, just their previous quarter. Um, well, this is for full year 2026 on this, what I pulled up here. And it looks like the current year they have 32% projected revenue growth. Partly a lot of due to the Alani that get brought in. And next year, they're looking at about 10% revenue. Personally, I think they're going to be growing revenue 10% minimum for the next 5 years into the future. I don't see a time where that's going to be stopping anytime soon. Net income 20% next 5 years. I think that's no issues at all growing at 20%. I'm not too worried about that. And this is a company that comes in and beats their numbers quarter in, quarter out. Look at their latest EPS beats, last 4 quarters. Definitely positive. So, looking at their dollar share in the energy drink category, this is just off their investor relations, their slides here. From Q1 2020, 2023, they've been dominating market share, taking it from Red Bull, taking it from Monster. You can see them in the orange there. They've slowly been moving up. One thing to note though, if you look there at the Q3 2024, they started slowing a little bit with just their core Celsius brand. That was something that many people I've seen just online have noted. That the Celsius brand is not growing quite as strong as it was. So that is something to keep in mind, but I think part of that was due to the whole Alani coming up, just taking a bunch of market share from everyone, which they have acquired. So you can see their market share here, 21%. I don't see a time when this is stopping anytime soon. I believe they'll continue to just rake in the market share from Red Bull, from Monster. Their Celsius brand is kind of seen as a healthy alternative to those. And a lot of people nowadays, I think, are moving towards that. So I don't see a time when this is stopping. Over to the income statement for them in this later Q1, the latest Q1 quarter, 138%. These numbers are a little bit skewed given that this was from before having Alani to now having Alani. So 138%, awesome. Gross profit was 120%. Selling and general administrative was actually only up 95%. Given that revenue, I love to see that number. One cause for concern that I think is there a little bit is the cost of revenue outpaced the just plain revenue number that they came in with. Usually you want to see your revenue higher than cost of revenue, that you have some leverage there in the business. I don't see this as a crazy number and a huge issue. Obviously, revenue is a much bigger number. So having cost of revenue outstrip it, income from operations was still up 167%. Great number, a lot higher than revenue, but I still don't like to see that cost of revenue so high. But I think management will figure it out. They're definitely looking at that number to see changes they can make for it, but still not a crazy concern there. Net income was great. EPS was great. But something I will point out is this weighted average shares outstanding. A lot of this happened due to stock-based compensation. You can see it went from 230s to high 250s thousand. This was largely due to the Alani deal. They issued a lot of shares to pay for that. It's give and take. Did they take out more debt? Not near as much as they would have, or at all. But this does hurt shareholders. A lot more shares on the market. People only buy a certain amount of shares at a time. So, yeah, it is what it is. Do I see them having a bunch of stock-based compensation in the future? I don't really see it. Maybe they bring on some more brands in the future, but I don't believe they'll be as big as Alani at all. Alani was pretty big when they took them over at a percent market share. Um, so is it a concern? Yes, but I don't see it that big of a concern in the future. All right, what's the value? So looking here at the forward PE of the company, and this is also from Yahoo Finance, I pulled this from. They're down to under 20 forward PE. That's pretty low, in my opinion. That's now lower than the market. And this is with them projecting 10% revenue and around 20% net income growth for 2027, not even including the crazy amount of growth this year. That's a really low number. You can see what they were doing in the past. In early 2025, they were, 40, they got up to 70. Now they're under 20. So this is a stock that's really collapsed on a forward P basis. And if we slide over to the PEG ratio, which is basically what you're paying for earnings and growth in the future. So this ties in that growth that they're projected out, down to 0.31. If you just look at a normal stock in the market, it's between 1 and 1.5. Monster Beverage there on the left is even a 1.3. So this is a stock that has no respect. The company has no respect whatsoever right now. Not a lot of people want to own this stock. And so that's just what it is right now. A lot of these multiples have collapsed. Obviously, we can see that in the share price. So we'll see what happens in the future. Looking here at the balance sheet, I didn't have any crazy concerns with this. Like I said earlier, a lot of what they took out for the Alani deal last year was stock-based compensation. They issued quite a bit of shares. And so cash, great. They have a lot more cash on the balance sheet. Liabilities stayed in check. Total assets was about the same. Nothing crazy blatantly bad about this. It's about the same. They got plenty of cash for the amount of debt they have and their liabilities. So it's not a company going away anytime soon. What I will point out here that caught my attention a little bit was the accrued promotional allowance, which is what they're spending on promotions. Could be in store, what they still have to pay, say like Walmart for pushing their brand out, promotional, like that kind of thing, what they still have to pay for that. That was up 30%, which is a pretty high number. I realized that their growth was over 100%. whatever that number was. So it's not a huge deal, but the Celsius organic growth was only 6%, excluding Alani, the little bit of Rockstar that they have. So I don't know how much of that was trying to get the Celsius brand, their core brand, moving and selling again. They group it all together, so maybe it was more for Alani. We don't know exactly. Um, but that's just something to consider. How much are they really having to advertise for that Celsius brands? And I hope we get some clarity on that in the future. I have full confidence in the management there that they'll figure that out, but nothing crazy red flags when it comes to this balance sheet. Another thing to note that I think is important is the volatility of this company. And this is not just a Celsius thing. Any growth company, high PEs, high forward PEs, PEG ratios, crazy. That's what they were. Celsius was in the past, at least. They're going to be very, very volatile. So this is just back towards 2020, excuse me, maybe back to 2019, but really their growth was 2020. They started down 40%, 60%, 30. They had an 80% drop in this company. This is what growth companies do. They're going to be volatile. In my opinion, if you can't handle huge crashes in growth companies like this, it's probably not a company you want to invest in. So that's just what it is what it's going to be. I personally think that when there is a crash like this, that's when you should be buying the company, but do your own due diligence on that. Just be prepared for if you buy a growth company that's got a crazy PE, it's going to be volatile. Do I know where the next 30% is for this company? Down, up, could go in a circle. Who knows? I have no idea. But do I think I know where the next 100% is? I think I do, which I'll show you here. This is my projections. Shout out to my brother for making this site for me. Um, I used to do all this math by hand, and now I don't have to because my brother went ahead and put it all into all my formulas in a site that I can use. So I went ahead and plugged in my data here. This is 2026 estimated revenue, net income, their EPS, what their growth rates are going to be. I rounded a little bit, so it's not perfect, obviously, but it's a close estimate. Revenue growth 10%, net income 20. I do not think those are crazy numbers. They're projecting around 10 and 20. I wouldn't be surprised if it's higher than that, given what I'm seeing with the sell through rates online and all that. I think it could be well 12%, but I'm going to keep it low just for my projections. So my base case, there in the yellow on the top, got 20% net income, a PE ratio of 25. I do not think that's crazy. And we got a CAGR of 28% out towards 2030. So that's awesome. But keep in mind the downside. My downside, I only put 15%. Maybe they grow revenues 7, 8%, so a little bit less than they think. Even if net income, I plugged in 10% here, say I dropped the PE a little bit, you're still mid to high single digits CAGR out towards 2030. And that's about in line with the market probably. So if I can get a base case that's in line with the market or right around there, I will take that all day long. In looking at this bull case, 25%, that's not a crazy number. If they get back to 12, 13, 14% revenue growth, which I think they can, in my opinion, slapping a 30 PE ratio on it, which is not crazy given that growth rate. I believe Monster is around 30. It could even be 35. Don't quote me on that. But if they can get back there, say they go 30, 35 PE, we could see a 40, 50% CAGR the next 4 to 5 years. maybe a 10-15% chance I'd put on that, but it's a possibility. My base case, probably 40-45% what I think is going to happen. So is it justified? The price? I would say no. Personally, I don't think it's justified at all. It should be much higher than the 30 a share it is right now, around 30. So I will be buying this. Full discretion, I already own quite a bit of it, but I will be continuing to buy it the next 2 to 3 months if the market decides to keep it cheap. But just make sure, full discretion, this is, you guys are all adults. You can do this on your own. Don't follow my investing side. Do your own research. But this is what I personally think is going to happen. Um, I'll love to see the future of this company. I believe the next 5-10 years of this company are going to be a fun ride. Um, and I showed you all the numbers to prove why I think that's going to happen. So yeah, hope you guys have a great rest of your day, and I'll see you in the next one. See ya.